Well, for more on the Fed's decision, we want to bring in Vishal Kunduja. He is Morgan Stanley's asset management co-head of broad markets fixed income. It's great to have you here. So when you take a look at the bond market's reaction, front end of the curve, you're taking a look at the 2-year had dropped. It was off just about 10 basis points after we initially got that decision. I'm curious just your first reaction to 50 basis point cut.
Definitely a little surprising, as the other commentators were mentioning on the show before as well. We were in the dovish 25 camp here. So surprise on the left-hand side, meaning on the front end, 50 basis points, but then not a surprise on the back end, 100 basis points next year, 100 for the year after that, a little shallower, bringing it down in terms of rates, and the terminal rate slightly higher by an eighth, if you will. And I think the very clear, like one of the things that was changed in the S&P was the unemployment was higher by about 0.4. So clearly remains the focus remains still on the unemployment side versus the second mandate, which is inflation. So slightly surprising on the front end, but then not so surprising on the back end. So steepening reaction from the bond curve is very, very legitimate at this point.
Vishal, now all eyes turn to Jay Powell at this presser. So let's say, Vishal, I'm going to make you a reporter. You cover the Fed. You're in that presser, Vishal. What would you ask Jay Powell? What's top of mind?
Playing the 50 basis points, I think that is the main thing right now. Is it a make-up 50 basis points? Because if you think about it, just rewind the clock back to the blackout period started on Monday. At that point, going into it, we were very clear, and the market was very clear with the dovish 25 basis points being the outcome here. So that change in thought process from that until today, I think that 50 basis points, if you will, market would require a little bit of that explanation, and then the explanation of the back end as well of why shallower is the confidence more in the soft landing sort of camp, or is it that a little bit of that catch up or make up that we are slightly behind the curve here to start off. So definitely that is top of mind for me at the moment.
Vishal, does this make you think twice about the soft landing camp, but whether or not you're confident that we are going to see a soft landing?
You know, from the data that we are tracking, and then the Fed also sees the same thing, I think definitely cooling or rebalancing. This is very clearly in our minds a recalibration cut cycle rather than recessionary cut cycle that they're getting into. And the timing is right. Maybe they were off by a meeting or two. But they have a lot in their toolkit. I think we are not even talking about balance sheet at this point. We have 550 basis points, or maybe just 500 at this point to go, but still a lot in the toolkit. So given that, and then you marry it with strong balance sheets on the consumer and corporate side that we are coming here at this point in the cycle with. So those two together, still our confidence is very high for a soft landing.
Even, Vishal, there was some kind of speculation out there. And this is from folks who thought Jay Powell wouldn't do 50 because they said if he does 50, the initial reaction may be positive and, muted positive reaction right now. Major averages up in the green. But then investors might think twice. They might think, well, why is the Fed doing 50? Why is the Fed doing a supersized cut? Maybe they see something in the data that we don't. What do you make of that argument?
No, definitely that we had the same discussions even this early as late as this early morning today as well, in terms of the pros and cons for 25 and 50. I think the back end dots have really helped that argument or present that argument very cleanly. They did not tinker too much with the statement. I know there are still a lot of red lines, but not drastic changes from the statement or surprising statements, changes in the statement. And then I think they re-brought that point back up into the focus that unemployment still remains their primary focus. So, trying to give us the dovishness there, but not trying to show us a lot more nervousness with the shallower path of decline in rates over the next 2 years. So I think it marries or it levels off some of that fear that we also had that a 50 basis points will bring out. What does the Fed know that we don't know? But I'm sure probably the first or the second question in the presser will be about that. In terms of explaining the background on that 50 bits.
So Vishal, given all this and given where the Fed stands right now, obviously we're going to hear a bit more from Powell in just a few minutes. But what is, I guess, your takeaway for bond market investors right now? What are you favoring as a result of this, just given the fact that there still is so much uncertainty surrounding the stability of the economy?
Stick with stronger balance sheets as bond as bond market participants. I think that is the first statement. I think there is a dual mandate that fixed income has, apart from the dual mandate at the Fed. It's income and negative correlation to risky assets. So that is, bond market has delivered on that over the last 2 years. We are outperforming cash. I think the next 2 years, with this kind of Fed and this kind of outlook on the economy and the rate cycle, I think fixed income will outperform cash. So we are still pretty bullish on duration. Steepeners is how we are positioned in the portfolios. We are pro-risk. We are liking securitized credit the best at this point. Some parts of the corporate balance sheets are overweighted as well. So there's quite a bit good to offer in fixed income, both from an income as well as a strong balance sheet perspective.
Vishal, thank you so much for being on the show today. Appreciate your time, sir.
Thank you.